Hello, folks. This is Doug Beck with Tailwind Wealth Management. I want to welcome you to another episode. I think today's content is going to stir up some debate, and it's meant to, but I basically have sat in front of CNBC for more than 10 minutes and was completely astonished by the total lack of knowledge by many of the industries, let me just call them luminaries. CEOs, high-ranking analysts and strategists of firms that are really hawking their own position because if the capital markets don't go back up in the near future, they're going to be in serious trouble. So this is really a one-sided story that you're receiving. The truth of the matter is far more dire, in my opinion, and that's what we're going to talk about today. Basically, here's a position we're in. The economy has, for all intents and purposes, been running with only the pilot light on. You know what a pilot light is? If you have a furnace, the burner are the big flames that are going, that are creating energy and heating your home. The pilot light's just that little flicker of a flame that makes sure the burner is on. The main flame for the global economy has been turned off. The US is in lockdown mode. Many of you, I'm sure most of you are aware, you can't even find fully stocked grocery stores. So do you think people are focusing on anything but the very basic items of subsistence? We're one of the largest consumer economies in the world, the US, if not the largest, and nobody's shopping for anything but food for the most part. Small and mid-sized businesses, meanwhile, are really being thrown a lifeline, but they're being told to still tread water in the middle of a pool for an undetermined amount of time. How much longer can they really survive? And these businesses are going belly up. Unemployment is skyrocketing, that's no secret. But what is misunderstood is that lending standards and lending practices are getting tighter in many of the areas of the economy. Well, at the same time, the Federal Reserve is pursuing basically a zero interest rate policy. So everybody thinks the Federal Reserve is bailing this country out, but it's not making it to the end consumer. Let's keep this simple, folks. If mortgage rates have gone up since the crisis began by almost a full point, it's tougher to buy a home. I go out there and I try to buy certificates of deposit or CDs through my firm that I'm custodying with for my clients, and the inventory has shrunk to almost nothing. Banks don't want the money. They don't want to lend. So therefore, how are you going to bail this economy out? Thank God you own real estate, right? That's the one shelter in this storm. Think again. The real estate market is basically shut down for now. Foot traffic has all but gone silent. And as I mentioned, with mortgage rates going up, what do you think that's going to do to overall purchases? It's going to bring it to a standstill. All these factors are compounding certainty in an already compromised position. Individuals are liquidating their investment holdings at an increasingly rapid pace just because they need to keep their businesses afloat. They need to feed their families. They need to meet medical bills. They need to continue putting their children through college when the colleges open up again. Last but not least, and hide all sharp objects now, let's talk about valuations. Stocks should be cheap now, right? After all, most averages are down 25% or more. Many sectors or certain sectors are off 50 or 60%. You have individual equities, small cap and mid cap equities that are off 70% or more. So there can't possibly be more bad news, right? According to the experts. Most of the experts are spending their time talking about how earnings are coming down and forecasting how much they'll come down. And therefore, when are we going to bottom in the major averages? The problem is they're not talking about the earnings multiple. To arrive at the end price, you take the earnings of the company or the index and multiply times a multiple. So right before we went into this bear market, the market was trading near perfection at a multiple of 20, and the S&P was around 3,000. So if you take 3,000 and divide by 20, you get $150 in earnings. The problem is not only are earnings coming down, but the multiple is going to deflate as well. It always does when you go through prolonged bear markets or significant, not even corrections, significant losses that are analogous to the bear market that we've had, the multiple will ultimately come down. So if we put a multiple on the S&P of 10 times and earnings decline 25%, you multiply those two together and basically you get an additional 50% downside potential from where we are today. Folks, that's extreme and nobody's talking about it. So what should an investor do given what I've just laid out? First of all, get a professional on your side who doesn't have any significant conflict of interest, who's not being paid based on sales quotas and certain products that some firms tell them to push. Only invest where you're able to lose, only invest in investments you're willing to lose money in, and only invest in an amount that you're able to absorb such a loss. It's a tongue twister. Keep plenty of dry powder at the ready. You can't take advantage of these tremendous bargains that might be in front of us if the market goes down substantially more if you're fully invested, because your investments will go down perhaps by 50%, and you'll just be swapping into other investments that are down just as much. So you need to have cash available for these what I call blue light specials. Also remember that in true financial panics, like the one we're in and will be for a while, everything gets cheaper than almost everybody thought it was capable of. So wait until there's panic in the streets. Wait until you are entirely pessimistic, uncomfortable, and queasy about the economy, the market, everything. Then and only then are we at the bottom of the market. Take care, be safe, we'll talk soon.